Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. Today, we are going to take a deep dive into Canadian non-refundable tax credits, specifically looking at the 2025 tax year. This is an absolutely essential area of personal finance here in Canada, and really getting a solid understanding of it can make a significant difference to your bottom line. So, first things first, let's nail down a critical distinction right from the start: the difference between a tax credit and a tax deduction. Think of a tax credit as a direct dollar for dollar reduction of the tax you owe. It's like a gift card for your taxes. A $150 credit means you pay exactly $150 less. A tax deduction, on the other hand, reduces your taxable income, so its actual value to you depends on your marginal tax rate. This is why credits are considered so equitable. They give the same dollar benefit to everyone, regardless of their income level. Now, here's something that often surprises people. You don't just get to claim these credits in any order you feel like. No, the Income Tax Act is very specific about the sequence. And this isn't just bureaucratic red tape. It's absolutely crucial for ensuring the calculations, especially for credits that can be transferred between family members, are done correctly. So we're going to follow that precise order throughout our discussion today.
So, here's our roadmap. We'll kick things off with the core personal and dependent credits, the ones that pretty much everyone uses. Then we'll get into credits related to different life stages, like age, pension, and employment. After that, we'll tackle the big ones: education and medical credits. Then we'll look at the interesting rules for donations and investments, and we'll wrap up with a couple of other key credits. It's a logical progression that will build your understanding step by step.
All right, let's get into our first section. We're talking about the core personal and dependent credits. You can think of these as the absolute foundation of your tax return, the real bedrock of tax savings for the vast majority of Canadians. The starting point for every single personal tax return is the basic personal amount. For 2025, if your net income falls below about $178,000, you can claim a base amount that's over $16,000. At the lowest federal rate of 15%, that translates into a direct tax saving of about $2,400. It's designed as a universal benefit, but as you can see, it does get phased out for higher income earners to ensure the benefit is targeted effectively. Next up, we have the spouse or common law partner credit. The idea here is pretty straightforward. It's to provide some tax relief if you're the primary financial support for a partner who has a very low income. Let's make this real with a quick example. So, you start with that same basic personal amount, $16,129. Let's say your spouse's net income for the year was just $2,000. You subtract their income from the base amount, which leaves you with over $14,000. You multiply that by 15%, and voila, you get a tax credit of $2,119. It's a simple inverse relationship. The lower your partner's income, the higher your tax credit. Of course, the tax system also acknowledges other types of financial support. There's the eligible dependent credit, which is often a huge help for single parents supporting a child. And then you have the Canada caregiver credits, which are specifically there to help those caring for relatives, whether it's a child or an adult, who have a significant physical or mental impairment. Okay, that takes care of the foundational credits. Let's shift gears now into our second section, which covers credits that are more closely tied to specific stages of life. Things like age, retirement, and your job. Once you hit age 65, you might be able to claim the age credit. But, and this is a big but, it's income tested. This means the full benefit is targeted towards those with lower incomes. Take this example: a senior with a net income of $50,000. You can see how their base for the credit gets reduced based on how much their income is over the threshold. They still get a very helpful credit of over $1,200, but this clawback mechanism ensures the maximum benefit flows to lower and middle income seniors. Now, there are a few other important credits in this bucket. You've got the pension credit, which applies to the first $2,000 of eligible pension income you receive. There's also the Canada Employment Credit, which is a small credit meant to help offset the cost of work-related expenses. And, of course, you get a credit for your mandatory contributions to EI and CPP throughout the year. All right, on to Section 3. Here, we're going to look at credits related to two of life's biggest expenses: post-secondary education and medical costs. These credits are designed to provide some very welcome relief. For students, the tuition credit is an absolute game changer. It's calculated based on your eligible tuition fees, but what makes it so powerful is its transferability. If a student doesn't earn enough income to need the full credit themselves, they can transfer a portion of it to a supporting family member, like a parent, grandparent, or even their spouse. Now, this chart is fascinating because it shows you exactly how that transferable amount is calculated. The rule is the student must use their credits to eliminate their own tax liability first. So they apply their basic personal amount, their CPP/EI credits, and their tuition credit to bring their own tax bill down to zero. It's only after their tax is zeroed out that any leftover amount can be transferred. So you see, the process follows a very clear logic. The student totals their credits, uses them to their own benefit first, and then, if there's an unused portion, a base amount of up to $5,000 can be transferred to a designated supporter. The student is always the primary beneficiary, which makes perfect sense. The medical expense credit is there to help people dealing with significant out-of-pocket health costs, but it's important to know that it doesn't cover every dollar. You can only claim the portion of your expenses that is above a certain threshold. And that threshold is the lesser of two amounts, either 3% of your net income or a fixed dollar amount, which for 2025 is about $2,800. This design ensures the credit is targeted to those facing genuinely substantial medical burdens. Okay, let's move into our fourth section. This one's really interesting because we're looking at two very different areas: how the tax system incentivizes charitable giving and how it deals with the income you earn from certain investments. The charitable donations credit has a really clever structure designed to encourage generosity. Here's how it works. You get a 15% credit on the very first $200 you donate in a year. But for every single dollar you give above that $200 mark, the credit rate jumps up to 29%, and it can even go to 33% if your income is in the highest tax bracket. It's a really powerful incentive to give more. Now, the dividend tax credit can seem a bit complex, but its purpose is actually quite elegant. It's all about avoiding something called double taxation. Just think about it. A corporation earns a profit and pays corporate income tax. Then it distributes some of that after-tax profit to you as a dividend. Without this credit, you'd pay full personal tax on that same income all over again. This credit is the system's way of acknowledging the tax the corporation has already paid. And this table just lays it out perfectly. Let's take a $1,000 cash dividend. The calculation involves a gross up, which estimates the corporation's pre-tax profit, and then a credit is calculated from there. But look at the final numbers. An eligible dividend, which typically comes from a large corporation that paid a higher tax rate, gets you a federal credit of $207. A non-eligible dividend? Only $104. The difference is huge, and it perfectly reflects the different levels of corporate tax that have already been paid. We're in the home stretch now. For our final section, we'll quickly touch on two more specialized situations: earning income in another country and making political contributions. If you earn income from abroad and pay foreign taxes, the foreign tax credit is your protection against being taxed twice on the same dollar. The whole mechanism comes down to a simple but powerful lesser of rule. As you can see here, your credit is limited to whichever amount is smaller, the foreign tax you actually paid or the amount of Canadian tax you would have paid on that same foreign income. In essence, Canada respects the tax you paid elsewhere, but only up to our own rates. And that brings us to the end of our overview. We've walked through the mechanics of the major non-refundable tax credits. But here's the thing. Understanding how to claim them after the fact is one thing. The real power comes from planning ahead. So this leaves us with the most important question of all. Now that you know the rules, how can you proactively structure your financial life? Things like income splitting or timing your medical expenses and donations to truly maximize the value of these credits, not just this year, but every single year.